Back with the market right here in 80 now, and the markets definitely are bleeding, although you may have a little bit of a recovery from the lows of the day, but doesn't seem like it's anything meaningful as of now. Some of the banks, yes, IndusInd Bank, Axis are perking up. There's a Britannia, TCS is seeing a little bit of a follow through from Friday, but look at the pain in the broader end of the market. CESC, HPCL, Kalyan Jewelers, Lodha, Interglobe Aviation, the entire consumption pack is where you're seeing extreme pressure built in. Even within the broader, or rather the large caps, M&M is your top loser on the index. And then there's a trend which has also been bleeding for quite some time now. But let's try and understand, since you talk about consumption, one of the key factors dominating all of that is inflation. And we've got the CPI note up ahead. So let's try and understand from Upasna Bhardwaj, senior economist at Kotak Mahindra Bank, as to what is it that she's penciling in terms of where the CPI is going to head. Upasna, hi, morning. Good to have you on the show. Upasna, what is your anticipation about the CPI? Because we are pegging it to further ease towards the 5.3% kind of mark.
Hi, we are at 5.4%, a marginal downside to the previous reading. Broadly, I think somewhere if you look at the food price index, that still seems to be holding up firm at around 9.1%. And that is something which we believe will keep the inflation slightly on the higher side. So I believe that we are marginally higher than the market. But having said that, I think overall, if we look at, then cereals, pulses, oils and seeds, all of that has started showing significant downside, and so the prices have been easing. And I think going ahead, that impact will be visible across easing of the headline food inflation as well.
All right. Hi, Upasna. This is Shrishti also joining in. But just today, Upasna, the headlines made that the rupee has fallen past that 86 per dollar mark for the first time ever. So wanted to understand what are your estimates with respect to the rupee movement ahead? Where do you see the currency headed? As well as do you anticipate that this movement can further put some pressure on the inflation number going ahead?
Yes, if you look at the factors which are driving rupee at this point in time, one is, of course, the broader dollar strength that is visible clearly across the board. And that is something which we are still awaiting clarity as to how long this, dollar bull run has to, keep going. And that is something which will keep rupee under pressure for sure. We are seeing significant amount of capital outflows. The FPI outflows is unrelenting, and that is keeping pressure on rupee. At the same time, what has changed really is that RBI is not keeping a tab on levels. RBI is not intervening to the levels that we have seen in the past, and that too is allowing more flexibility for rupee to move. So in all of this, clearly, with all the global headwinds that we are looking at, let me just also add that crude oil prices is another important factor. And, over the last few days, we have seen crude oil prices go significantly higher. And with additional sanctions on Russia, it does further put pressure on rupee. So all of this would weigh on rupee going forward, and dollar rupee should trend more higher, especially as RBI allows for more movement. So in this, honestly, the levels are difficult to say, but yes, we are looking at the range shifting now towards 87, 87.50. So over a period of next few months, we will see 86.5 to 87.5 range, away from the current range that we are looking at. And as you mentioned, yes, all of this will weigh on the overall global side of inflation, and the imported inflation would start pouring in again back. So we will be watchful on this front. We will have to see, of course, how much of that pass through of the higher oil prices and the impact of rupee we really start seeing in our domestic inflation scenario. But overall, yes, it does pose an upside risk to headline inflation.
And what is it that you're penciling in that, Upasna? Because like you said, that, the global parameters clearly are a challenge. Having said that, food inflation, of course, has eased. Given that you do think that there are upside risks to your inflation estimates, what's the band or the range that you're calling?
Next year, we're looking at 4.2% at the moment. But if I was to assign some upside risk coming from the imported inflation side, then I would say this average could shift by 20 basis or 25 basis. But again, like I said, it will depend on how much of pass-through happens from oil and currency both. But yes, it does post 20-25 basis of an upside to our average inflation of 4.2% currently.
All right, Upasna, on to some of the other macro data, what we see is that yes, indeed, there are hopes on easing the inflation, but the IIP number is at a 6-month high as well. So does that make a case for a rate cuts going ahead according to you? Because just in February, there are some hopes that there will be rate cuts. So wanted to understand, what are you penciling in?
We too are expecting a rate cut, because if we look at the overall state of the economy, while IIP tends to be very volatile, we should keep that in mind. Of course, the number has been robust, but a large part of this is also supported by a favorable base effect. Q3, of course, has to be slightly better than Q2. Q2 was very weak in terms of economic activity, if we look at, and corporate earnings too suggested the same. And we are looking at some kind of a payback or of improvement in the third quarter, and even going into the fourth quarter as well. But having said that, I think overall we remain fairly bearish on the full year GDP numbers. We are at 6.1% for FY25, and even next year, we have a lot of uncertainties which are there, and despite that, of course, we are looking at a number which will be definitely lower than 6.5%. So overall, given that downside risk to RBI's and the government's estimates of GDP is much more, we assign a possibility of a rate cut cycle beginning from February. But having said that, we'll have to look at the global environment and also, account for any likely adverse spillovers that could happen. And hence, it will be a closed call, but we are looking for overall 50 to 75 basis of rate cut through CY25, and probably starting from February itself.
Right, so all eyes on the February meeting. But Upasna, with this, would like to thank you for taking the time out, speaking with us. Pleasure talking to you.
If you like this video, then like, share and subscribe to ET Now.